Okay, the transition to electric vehicles represents a once-in-a-lifetime opportunity for discontinuous innovation and architectural upheaval in the automotive supply chain, writes our next guest. Truist Managing Director William Stein joins us now. William, good to see you here this morning. It seems like not a day goes by without some form of new car EV launch from some form of automaker. This week, Lotus come out with a hyper SUV, whatever that is. But what do these releases mean for the chip makers?
Well, it's a significant potential change for the chip makers. There's approximately doubling of the semiconductor content in a typical internal combustion engine, in a typical electric vehicle relative to a traditional internal combustion engine. It's a significant uplift, somewhat of a change of the major vendors, but a big uplift in semi-content.
William, it's Julie here. When you look at the rate of adoption and planning for electric vehicles versus what was expected, how is that tracking? And then are the semiconductor makers that service the industry, are they keeping up with that adoption?
Yeah, so penetration, we believe, is approximately 3% of global auto production today. It's relatively modest. About a year ago, there was an expectation for by the time we get to 2040, perhaps 40, 50% penetration, but that's gone up significantly in the last year, mostly because of both legislation in the world, government targets, but perhaps even more than that, targets established by the auto manufacturers. Those have been pulled in and accelerated, in terms of the percentage of their fleet they intend to make electric and the timing on which they expect to achieve that. Both of those have been pulled in significantly in the last year. We believe the semiconductor companies are, ramping to support this. There are ongoing shortages. I'm sure you're well aware of that, as are all of your viewers, that this has been an issue with production. I don't think it's been limited or even over focused in the electric vehicle market. I think it's been, fairly significant through the whole industry, especially the internal combustion cars.
William, Julie's had some really great chats recently with Nvidia CEO Jensen Huang, and he really has gone into great length what he plans to do in many different areas of his own business, of course, one of them being autonomous driving. Is Nvidia one of the main winners in the chip supply and just given this push into EVs?
So Nvidia does not have a meaningful position in the transition from internal combustion to electrification. The major suppliers of semiconductors that are enabling that transition, if you just isolate the propulsion mechanism, right, internal combustion to electric, you're talking about power semiconductor suppliers. Companies like Infineon, Cree, Wolfspeed, on semiconductor. Those are the ones that have really that are really participating in this drive on the propulsion side. Where Nvidia plays or is attempting to play is in this very long-term vision when ADAS or advanced driver assistance systems get so advanced that they enable autonomous or close to autonomous driving. And that is the area where Nvidia plans to have a very significant position in the market.
So it sounds like you think the electric vehicle opportunity is certainly sooner than the autonomous vehicle opportunity. What about the relative size of those opportunities and the importance for the chip industry?
Yeah, so they're very different opportunities. We've done much more work recently on the electrification part. There's two camps of thinking around autonomous vehicles. One is this sort of moonshot approach that many vendors, many suppliers and technology companies have been attempting for a long time to say, I'm going from a regular car to a car that has all the technology to drive itself, and I'm going to get there in one step. There's another approach, a very different approach, which is some technology companies, Mobileye, now a division of Intel, sort of been the most emblematic of this approach, is more incrementalist. In other words, we're going to provide technology to make the car a little safer and avoid avoid different types of potential accidents. We're going to achieve that objective slightly better each year, each model, and each release of the new technology. And eventually, perhaps we get to a point where we have autonomous driving. That approach has proven to be the more predominant one among the OEMs today, the equipment manufacturers, the companies making cars. They've more leaned into that approach. So we think this is going to be still more of an incrementalist market over time.
You bring up an interesting point, William, in one of your notes that the EVs, the chip companies that are most tied to this push into EVs are under-owned by ESG-related ETFs. What's causing that?
Yeah, I don't know specifically, right? My assumption is that the managers of ESG focused investors, ESG focused funds, probably inspect a wide variety of metrics and perhaps rely on metrics created by third parties that measure these companies based on those three vectors: environmental, social, and governance. The point that I was trying to make in the note that you referred to is that these power semiconductor companies are really at the heart of the technology that's enabling this significant change in the way we consume energy. Automotive is a very big part of our daily energy consumption. It's going from gasoline to electric power. And I would think that someone who's involved in ESG investing would want to have exposure to that theme and to the companies that are really at the heart of enabling it. So we tried to evaluate what the weighting of these stocks is in the Russell 1000 and the Russell 3000, which tend to be the universe of stocks that these ESG funds focus on. And we compared the weighting of these stocks in the ESG funds relative to the Russell. And what we found is that they're underweighted, not overweighted. We think over time, this is probably going to change. This is probably going to be a tailwind for these stocks, sort of forced purchasing of these very environmental linked stocks.
And William, finally, moving away from this sort of ETF buying for a moment, you mentioned in passing that one of your top picks is on semiconductor, is linked to this EV thesis. And I just wanted to get you to expand on that a little bit more and why ON is particularly poised to benefit from this trend.
Yeah, first, I think it's fair to say that we're quite positive on this theme across semis. I don't know that there's any losers per se. There are companies that have very big exposure to automotive that may not get the kick of growth from the transition to electric vehicles. And there are some smaller companies like Monolithic Power and Diodes that we think are sort of sneaky ways to invest in this theme because we think they have sort of accelerated growth from this transition. But for companies like ON, ON sort of sits in the middle. They have a lot of automotive content, but the company has been vertically integrating a capability in a particular type of semiconductor called silicon carbide power switches. And they acquired a company called GTAT to grow the base semiconductor material, that's silicon carbide. And they're currently developing or enhancing their ability to develop full semiconductor devices from those wafers. And we think that company's had a very good capability or has had much success in getting design wins of these silicon carbide power modules at the EV vendors. And we think that's certainly partly understood by the street, but we think there's more success coming than what the company's let on so far.
All right, we'll leave it there. Truist Managing Director William Stein, good to see you this morning. Have a great rest of the week.